The yield on the 10-year Treasury note just crossed 4.87%. The federal deficit is running at $1 trillion for a single fiscal year. And the man who was supposed to manage all of it, the chairman of the Federal Reserve, and is now openly under political siege, with the White House signaling it wants him gone before his term expires. That is not a rumor. That is not a fringe theory. That is the headline the mainstream financial press buried under stock market recovery stories and earnings optimism. You are watching this because you already suspect something is wrong. Not slightly off. Fundamentally, structurally, arithmetically wrong. And what I am going to show you over the next 18 minutes is that the pressure building in the U.S. economy right now is not a correction. It is not a dip. It is a system that has been stretched so far past its design limits that the people running it are now fighting each other over who controls the pressure valve. Let us start with the number that nobody wants to explain. $36.2 trillion? That is the current U.S. national debt as of this recording. But the debt itself is not the crisis. The crisis is the cost of carrying it. Because when interest rates were near zero, a $36 trillion debt load was manageable. Painful, but manageable. Now, with the Fed funds rate sitting above 5% for the longest sustained period since 2001, the U.S. government is paying over $1 trillion per year just in interest. Not principal, just interest. $1 trillion? Gone. Every year, before a single road gets built, before a single soldier gets paid, before a single Social Security check goes out, that number should stop you cold. Because here is what it means in practical terms. The U.S. government is now spending more on interest payments than it spends on national defense. More than Medicare, more than Medicaid. The single largest line item in the federal budget is not healthcare or military readiness. It is the cost of money that was already spent. But that is not the part that should concern you most. What should concern you is what happens when a sitting president publicly attacks the independence of the central bank in that environment. Because Jerome Powell, the Fed chairman, has made clear that he will not cut rates simply because the White House wants him to. He has said on the record that premature rate cuts risk reigniting the inflation that cost ordinary Americans 15 to 20% of their purchasing power between 2021 and 2023. And the White House has responded not with counter data, but with public threats about firing him. Now, here is where the numbers stop making sense in the way you were taught. The Fed is supposed to be independent. That independence is not just a procedural nicety. It is the structural guarantee that backs the dollar's credibility with foreign holders, central banks, sovereign wealth funds, institutions in Tokyo, Riyadh, Frankfurt, and Beijing, who collectively hold over $7 trillion in U.S. Treasury securities. Their willingness to keep holding those securities is predicated on one assumption, that the entity managing U.S. monetary policy is making decisions based on economic data, not political pressure. Paper says the Fed is independent. The reality in Washington right now says something very different. And gold knows. While equities bounced and crypto headlines dominated the scroll, gold crossed $3,300 per ounce and held. Silver pushed above $33. The Shanghai Gold Exchange premium over the London Fix widened to levels not seen since the 2022 energy shock. The physical market is pricing in something the paper market has not fully acknowledged yet. Once you understand the ratio, once you understand what it means when Eastern physical demand diverges from Western paper pricing, the price action makes complete sense. But let me back up, because there is a sequence here that matters. 3 things happened in a very short window of time. First, the White House escalated its public criticism of Jerome Powell, with senior officials floating the idea that a president can legally remove a Fed chairman for cause. Second, gold broke above its 2024 highs with unusual conviction, not on a single-day spike, but on sustained, quiet accumulation across multiple sessions. Third, COMEX registered gold inventories, the physical gold that has been formally declared available for delivery, dropped by 412,000 troy ounces in a single week. 412,000 ounces. Gone from registered status in 7 days. That does not happen randomly. Registered inventory at COMEX represents metal that has been assayed, vaulted, and explicitly offered to back paper contracts. When it moves from registered to eligible, meaning it is still in the vault but the owner has pulled it back from the delivery pool, it is that is a signal. The owner is saying, I am not selling this at the current paper price. I am waiting. And here's what they filed in the exchange's own data that almost nobody is talking about. The total open interest on COMEX gold futures sits at approximately 460,000 contracts. Each contract represents 100 troy ounces. That is 46 million ounces of paper gold outstanding. The total registered inventory, metal actually available to back those claims, stands at approximately 3 million ounces. Do the math with me. That is a ratio of over 15 paper ounces for every 1 real ounce sitting in deliverable position. 15 to 1. The gap did not close. It widened. If you are new to this channel, welcome. This is the hidden economy, where we track the data points that institutional desks see and retail investors never hear about. If this kind of analysis is what you have been missing, subscribe right now, because what I'm about to walk you through in Act 2 goes deeper than any mainstream financial outlet will take you. Here is what you need to understand about the Federal Reserve's independence, and why it matters specifically to the price of gold and silver, not just to macroeconomists and policy wonks. When Paul Volcker raised interest rates to 20% in 1980 to kill the inflation of the 1970s, he did it against enormous political pressure. President Carter's administration was furious. The economy went into recession, unemployment spiked, Volcker held, the Fed held, and inflation collapsed from 13.5% to 3.2% in less than 3 years. Same playbook, different decade. Because the reason Volcker could hold was that the bond market, and the foreign holders within it, trusted that the Fed was making a purely technical, data-driven call. The moment that trust cracks, you get something else entirely. What you get is what happened in the United Kingdom in September of 2022. You may remember it as the Gilt Crisis. Prime Minister Liz Truss announced an unfunded tax cut package. The bond market responded within hours. UK gilt yields spiked so fast and so violently that pension funds with leveraged positions on long-duration bonds faced immediate margin calls. The Bank of England had to intervene with emergency bond purchases to prevent cascading liquidations. Truss resigned 45 days into her tenure. The bond market fired the Prime Minister of the United Kingdom. That is not ancient history. That is 2 years ago. Now I want you to hold that image, a government trying to force easy money, a bond market that punishes the attempt, and look at what is unfolding in the United States right now with fresh eyes. The administration wants lower rates. The Fed refuses. The administration escalates threats against the Fed chairman's job security. And in that same window, in that exact same window, foreign central bank appetite for U.S. Treasuries starts to shift in ways that are quiet but measurable. China reduced its holdings of U.S. Treasury securities by approximately $48 billion over the past 12 months. Japan, the largest single foreign holder, trimmed its position by roughly $30 billion. This is not a panic sell. It is a slow, deliberate reallocation. The kind of move you make when you are not sure the institution managing the currency you are holding is going to remain credible. But here is what should really disturb you. The buyer of last resort for U.S. Treasuries, when foreign demand softens, is the Federal Reserve itself, through quantitative easing or domestic institutions forced to hold government paper through regulatory requirements. If the Fed is simultaneously being pressured to cut rates and being threatened with leadership replacement, the credibility mechanism that keeps foreign holders comfortable begins to erode. And if foreign holders reduce their Treasury exposure at the same time domestic rates are being pushed lower by political intervention, you get a scenario that is genuinely without modern precedent in the United States. You get a currency under pressure from two directions at once. Internally, from rate suppression. Externally, from demand withdrawal. Wall Street is not confused about what this means. They know exactly what this means. This number does not exist in a fair market. The US dollar index has held above 100 for most of the past 2 years, even as the debt burden expanded, even as foreign treasury demand softened, even as the deficit widened. The reason it held is precisely Fed independence, the market's belief that rate policy would be determined by inflation data, not by executive preference. Remove that belief, and you remove the floor. Let me show you the pattern across 5 data points, because one anomaly is a data quirk. 5 anomalies with the same directional signature is something else entirely. First, gold. We established the COMEX, registered to open interest ratio, 15 paper ounces per deliverable real ounce. That ratio was 8-to-1 in 2018. It has nearly doubled, and it has been moving in one direction, more paper, less physical, for 6 consecutive quarters. Second, the Shanghai Gold Exchange. The premium on physical gold in Shanghai versus the London Bullion Market Association spot price has averaged between $12 and $18 per ounce for the past 6 months. In normal conditions, when when the paper and physical markets are aligned, that premium should be negligible. A $2 to $3 arbitrage at most. A sustained $12 to $18 premium means Eastern buyers are paying significantly above Western paper prices because they want physical delivery, and they are not getting enough supply at the paper price. The premium held through the entire dump in January. It held through the February equity sell-off. The premium held. Third, silver lease rates. The annualized cost of leasing physical silver, borrowing real metal from a vault and returning it later, spiked to over 4% for short-duration contracts in February. Lease rates are a direct real-time signal of physical tightness. When it costs 4% per year to borrow a physical ounce, it means the people who have physical silver are not willing to lend it cheaply because they are not confident they can replace it at today's prices. For context, silver lease rates were below 1% for most of the 2014 to 2020 period. They have more than quadrupled. The West is still pricing this like 2019. Fourth, U.S. Mint Silver Eagle sales. The U.S. Mint sold over 4 million Silver Eagle 1-ounce coins in the first quarter of this year. That is the highest quarterly retail coin demand since 2021, the year silver spiked to nearly $30 on the Wall Street Bet squeeze. And here's the detail nobody is headlining. The Mint has been on allocation restrictions. Authorized purchasers, the dealers who buy directly from the Mint, cannot get as many coins as they want. The Mint cannot produce enough to meet demand. Paper says silver is priced in the low 30s. The vault is struggling to fill orders. Fifth, JPMorgan's positioning. The bank's most recent Commodity Futures Trading Commission disclosure shows a net long position in COMEX silver futures, not just in physical holdings but in futures, of approximately 47 million ounces. Now, JPMorgan spent the better part of a decade as the dominant short in the silver market. They paid nearly $1 billion in fines in 2020 for a spoofing and market manipulation scheme that suppressed silver prices for years. Their traders literally admitted in court to placing fake orders to move prices in directions that benefited their book. Why did JPMorgan reclassify over 13 million ounces of silver from eligible to registered status in a single reporting week last month? That is not a rhetorical question. That is an actual filing on the CME Group's own public data portal. 13 million ounces moved from eligible, vaulted but not for delivery, to registered, formally offered for delivery. The largest single-week reclassification in recent COMEX history, happening at the exact same moment the Fed's credibility is being openly challenged by the executive branch. Why are they repositioning now? What do they know that the paper price has not yet reflected? And then something strange happened to the vault numbers. In the same week that JPMorgan added 13 million ounces to registered silver, total COMEX-eligible silver inventories, the broader pool of metal in vaults, declined by 9 million ounces. Two things moving in opposite directions simultaneously within the same system. Metal being pulled out of the general eligible pool, and one major bank moving its own metal into the deliverable registered category. That is not coincidence. That is preparation. If this analysis is landing for you, if you are starting to see the shape of what is building, this is exactly the kind of pattern tracking we do here on The Hidden Economy every single week. Subscribe and hit the notification bell, because the next piece of this, the piece that connects the Fed fight directly to what happens to your purchasing power, you will not want to miss. How can over 350 paper claims exist for every single real ounce in the deliverable system? That question matters not because a delivery squeeze is inevitable tomorrow, et it may not be. It matters because the answer tells you who is exposed and who is protected when the reckoning arrives. Let me give you the historical anchor because this pattern has a very specific fingerprint. In 1979 into 1980, the Hunt brothers accumulated approximately 100 million ounces of physical silver, roughly a third of the world's above-ground commercial supply. The paper price of silver went from $6 an ounce to $50 an ounce in less than 18 months. The COMEX responded by changing the rules mid-game. They imposed liquidation-only trading, meaning you could sell your silver futures but not buy more. It was the exchange itself intervening to stop a squeeze that threatened to expose exactly how many paper claims existed without physical backing. Silver crashed. The Hunt brothers were wiped out, and the rule change, imposed at the moment that the paper-to-physical ratio was about to matter, was called Silver Rule 7. Once as accident, twice as coincidence. 3 times as policy. In 2011, silver reached $49 per ounce. Within 8 trading days of that peak, the CME Group raised margin requirements on silver futures 5 times. 5 margin hikes in 8 days. Each hike forced leveraged longs to put up more cash or close their positions. Forced selling cascaded. Silver dropped from $49 to $32 in 3 weeks. The paper price was broken. The physical premium at coin dealers and bullion vaults held for weeks afterward. The paper said 32. The vault said something different. Same playbook. Different decade. Now we are in 2026. The paper-to-physical ratio is at 15-to-1 on gold. Silver lease rates are at 4%. JPMorgan is repositioning. The Shanghai premium has held for 6 consecutive months. And the institutional actor theoretically tasked with maintaining economic stability, the Federal Reserve, is being openly threatened with political capture. The villain here is not one person or one bank. The villain is the system. The same system that changed the rules in 1980. The same system that hiked margins in 2011, a system that functions perfectly well for the institutions that designed it and extracts wealth from the retail participants who enter it, trusting that the prices they see reflect reality. Let us talk about who gets hurt. Not in abstract macro terms, in real portfolio savings account terms. There are 3 types of people watching this right now. Type 1 is scared. Type 1 sees the headlines about the Fed being fired and the debt at $36 trillion and interprets it as noise, too big to be real, too systemic to matter to them personally. Type 1 stays in the dollar-denominated system because it is familiar, and familiarity feels like safety. Type 1 will be the most surprised. Type 2 is frozen. Type 2 understands that something is wrong. Type 2 has maybe bought a little gold, maybe has some cash on the sidelines, but cannot make the final decision because the mainstream financial media keeps producing reassuring commentary about soft landings and Fed pivots and equity market resilience. Type 2 is watching this video right now with a pit in their stomach because what they are hearing confirms what they already suspected but did not want to fully believe. Type 3 understands the ratio. Type 3 has been watching the paper-to-physical divergence for months. Type 3 knows that the Shanghai premium is not a data anomaly. It is a demand signal from the largest physical gold and silver accumulator on the planet. Type 3 is not panicking. Type 3 is positioning. You are watching this because you are somewhere between Type 2 and Type 3. And by the end of this video, you will have enough data to close that gap. Here's the implication that the institutional world is sitting with right now, and that has not yet hit the retail conversation. If the Federal Reserve's independence is compromised, even partially, even by appearance rather than formal legal removal, the credibility of U.S. rate policy as a signal becomes unreliable. And when rate policy credibility cracks, the dollar's role as the world's reserve currency does not disappear overnight. But it wobbles. And when it wobbles, the countries that have been quietly accumulating gold for the past decade, China, Russia, India, Turkey, Saudi Arabia, suddenly find themselves holding an asset that the market is revaluing upward in real time. China's central bank has added gold to its reserves for 17 consecutive months. 17, that is not a trend. That is a policy decision with a decade-long horizon. They are not buying gold because they think it will go up next quarter. They are buying gold because they believe the dollar's dominance in global trade and finance is structurally declining, and they want to hold an asset that carries no counterparty risk in the world that follows. The West is still pricing this like 2019. The East has been preparing for 2030. Now let us bring it back to the Fed fight and why it accelerates the timeline. The moment a U.S. president removes, or succeeds in pressuring out, a sitting Fed chairman for refusing to cut rates, the message sent to every foreign treasury holder on the planet is this: U.S. monetary policy is now subject to political override. The insulation between fiscal politics and monetary decisions no longer holds. That message does not cause a currency crisis the next morning. Markets are not that immediate, but it changes the calculus for every sovereign wealth fund, every central bank, every institutional treasury buyer over the following 12 to 24 months. The marginal buyer of U.S. debt at 4. 5% becomes the marginal seller of U.S. debt at 4. 5% if they believe the real rate is about to be politically suppressed below inflation, and when the marginal buyer becomes a seller, rates rise. Not because the Fed wants them to, because the market forces them to, because the bond market, as the UK discovered in 2022, has the capacity to override any government that tests it. What happens to your savings when that ratio collapses? Think about what you actually hold. If you have a 401k or an IRA invested in US equities and bonds, you are holding assets denominated in and priced by the very currency under pressure. If rates spike because foreign demand for treasuries softens, bond prices fall. If bond prices fall, pension funds and insurance companies holding long-duration bonds face losses. If those institutions face losses, they sell equities to cover. Equities fall. Your portfolio, your retirement account, your savings, all of them move in the same direction at the same time. Down. This is called correlation risk. In normal markets, bonds and equities provide a hedge against each other. In a dollar credibility crisis, that hedge breaks. Everything denominated in dollars falls relative to assets outside the dollar system. Gold is outside the dollar system. Silver is outside the dollar system. They are not hedges in the portfolio theory sense. They are exits. This is not financial advice. Your money, your decisions. But what I can tell you is that the data points we have walked through today, the 15-to-1 paper-to-physical ratio at COMEX, the sustained $12 to $18 Shanghai premium, the 4% silver lease rates, the 17 consecutive months of Chinese central bank gold accumulation, JPMorgan's 13 million ounce repositioning, and none of these data points exist in isolation. They are telling the same story from different angles. Paper says the U.S. economy is in a managed slowdown. The vault says something different. Here is what the informed viewer needs to understand about the sequence from here. The Fed's next scheduled policy meeting is in May. Between now and that meeting, the political pressure on Powell will intensify because every week that rates stay elevated is another week that the administration's economic narrative, which depends on lower borrowing costs, looser financial conditions, and an equity market that validates the political story, gets harder to sustain. Powell will almost certainly hold rates again. The data does not support a cut. Core PCE, the Fed's preferred inflation measure, is still running at 2.8%. The target is 2. Cutting rates with core inflation at 2.8 is not a pivot. It is a political capitulation. And if Powell capitulates, the dollar is the casualty. If he does not capitulate and if he holds as Volcker held, the executive pressure will escalate. And the escalation will become a story that the bond market cannot ignore. Either way, the pressure does not release. Either the Fed cuts and inflation reaccelerates and gold re-rates to new highs as real rates turn negative, or the Fed holds and the political fight over its independence becomes a credibility event that foreign holders use as cover to continue their quiet reallocation away from treasuries. The path forks? Both forks lead to the same destination for physical precious metals. Wall Street is not confused. They know exactly what this means. The question is whether the retail investor, the person whose savings are almost entirely in dollar-denominated paper, understands it before the re-rating happens or after. The spread between what the paper market is pricing and what the physical market is demanding is the widest it has been since 2020. In 2020, the paper-physical divergence was driven by a pandemic liquidity shock, dramatic, temporary, and quickly closed. This time the divergence is being driven by structural forces. Institutional reallocation, sovereign accumulation, political credibility erosion. These do not resolve in a single quarter. Send this video to one person who is sitting on the sidelines right now waiting for the right moment to diversify. Because here is the uncomfortable truth about right moments. By the time the mainstream acknowledges that this divergence is real, the physical premium will have expanded further, the paper price will have caught up to the physical bid, and the entry window will have closed. Most people will never see this analysis. The mainstream financial media will not run it because their advertising model depends on the same institutions that benefit from you not knowing the ratio. But you saw it. Now help one person you care about see it too. Drop a comment right now telling me, do you think the Fed survives politically intact through the end of this year? I read every single comment. Your answer will shape the follow-up I produce next. Before I give you the final unresolved question that is going to sit with you after this video ends, subscribe right now. Hit the notification bell, because the event I am pointing you toward is time-sensitive, and if you miss the next video, you will have missed the context you need to understand what comes after. Here is where we land. The US economy is not broken. It is stretched between a political apparatus that needs lower rates and a monetary system that cannot deliver them without triggering the very inflation it just spent 3 years fighting. Stretched between a paper derivatives market pricing gold and silver at one level and a physical accumulation market in Shanghai, Mumbai, and Riyadh paying a persistent premium above that level. Stretched between a $36 trillion debt load and the rising cost of servicing it at rates that the executive branch is now openly trying to force lower. Once you understand the ratio, once you see the 15-to-1 paper coverage at COMEX, the 17 months of Chinese accumulation, the 4% lease rates, the widening Shanghai premium, the price action makes complete sense. Gold is not going up because investors are panicking. Gold is going up because the people who understand the structure of the system are exiting the paper layer of it and moving into the physical layer, quietly, consistently, every single week. The premium held through the January dump. The premium held through the February correction. The premium is holding right now. This number does not exist in a fair market. A 15-to-1 paper-to-physical ratio at the world's largest commodity derivatives exchange is not a function of supply and demand. It is a function of a system that has been extended well past the point where it can deliver on its own contracts if enough participants ask for delivery at the same time. That system is under political pressure from the outside. That is new, and new pressure on an already stretched structure does not produce stability. It produces a snap. The question I want to leave you with, the one question this video cannot answer because the answer depends on a decision that has not yet been made, is this. When the May Fed meeting arrives and Powell announces his decision and the White House responds at which direction does the dollar move first? Because the direction it moves first will tell you everything about how much time is left before the paper-to-physical gap in precious metals becomes impossible for the mainstream narrative to explain away. The first COMEX delivery notice window after the May meeting opens on May 30th. Watch the registered inventory numbers. Watch the Shanghai premium. Watch what the vault does, because the vault will tell you what the paper price is still hiding. The script is exposed. Now watch what happens next.